In this video, we are going to take a look at how tariffs will impact United States economy and stock prices in the near future. And please stay till the end of this video because I will play a video clip showing you exactly the impact that the steel tariffs already having on the US economy. So from a perspective of a business, higher costs of steel and aluminum are represented in the higher costs of raw materials. Anything that has to do with steel production, anything started with cans that you see at the grocery stores and so on, anything that has to do with steel and aluminum is going to increase the cost of production of anything that involves those things. That's going to lead to lower profit margin for the companies. We are already in the United States at an almost full employment type situation where unemployment is currently at 4%. So the businesses already having a situation where they're struggling to hire people at a reasonable amount. So they're already experiencing an increase in costs of the labor for their business. Now they're experiencing the increase in costs of the raw materials. Combined, they have no other alternatives but to increase the prices of whatever goods they're selling. Higher prices result in sales declines because less people are wanting to buy the products at a higher price. If you take the sales declines and the increased costs, that leads to lower profitability of the company that is manufacturing those products. Now, if the company is not making as much money, they're not able to keep as many employees. So people are going to start losing jobs and they will end up at the unemployment line. So ultimately, this will result in higher unemployment. As far as the stock price is concerned, and this is the question that we're interested in knowing, what's going to happen as a result of higher tariffs to the stock market? Well, lower profitability and lower sales are typically the metrics that are considered in evaluating a company. So if the company is projected to have lower sales, lower margins, and higher costs, in your opinion, should its stock be worth more or less? Well, of course, the answer is less. So as a result of lower profitability and sales, we will see a lower valuation metric that will be applied to numerous companies and their stock market multiples. So overall, we're looking at lower stock prices. Now, it gets actually worse from the standpoint of a consumer, okay? Since now, the costs of production increase and the businesses have to increase the costs. Well, everything that has to do with steel and aluminum is going to have a price hike. Increase in the cost of products to end consumer, of course, results in higher prices across the board. Higher prices across the board in the United States result in inflation or weaker dollar. In the case of inflation, weaker dollar, we're going to have rising interest rates. As you probably know, the credit collapse in 2008 was caused when people that took out these adjustable rate mortgages, where the rate was adjustable, and when they had to refinance 3 years later, they simply couldn't afford the houses. And quite honestly, they didn't know any better. Well, this time when people are taking adjustable mortgages, it is no longer 3-year adjustable, it is a 5-year adjustable. So all we're seeing is just a slight delay. The only problem is the situation is going to be much worse Why? Well, because the interest rates are going to be significantly higher than they were before the credit collapse in 2008. It will also affect anybody that has credit cards, because whether you realize it or not, when the interest rates go up, credit cards, they're an adjustable rate type instrument. So when interest rates go up overall, then your credit card interest will go up as well. As you probably know, the level of credit card debt in the United States is in excess of $1.3 trillion. What do you think is going to happen if the rates rise? Are more people going to be able to make their credit card payments, or less people going to be able to make their credit card payments? Well, of course, the answer is a lot of people can barely make their credit card payments right now. If they owe 10 grand on the credit card and the interest rate goes up from 18 to 22%, what is the probability of them making that minimum payment now if they can't even do it currently? So anything from adjustable mortgages to credit cards, and if you don't believe me, just look at your credit card agreement. It tells you right there in black and white that if the rates go up, so will the cost of your credit. Now, if the cost of mortgages go up, if the cost of credit cards go up, if the cost of borrowing goes up, do people have more money or less money to spend on other stuff? Well, the answer is less. So the consumer is not able to spend as much as they're able to spend now. How does that go along with the higher prices in the market? Well, it doesn't go there well, right? Overall, we're going to have a weaker consumer. The demand for goods is going to decline. How's that going to impact the companies? It's going to impact the demand for their products. So here's the vicious cycle. The companies are not going to be able to sell as much. If they're not able to sell as much, they're going to have to lay off workers. More people end up at the unemployment line. It's just too sad that we can't seem to be able to learn it from the history. The tariffs did not work in the 70s. They did not work in the 80s. As a matter of fact, please take a quick look at this study made by Robert Crandall from Brookings Institution on the effects of U.S. trade protection for autos and steel. Despite the trade protection of the late 1970s and 1980s, the integrated steelmakers were forced to launch a major retrenchment in the early 1980s. These companies began closing plants, reducing capacity from 138 million tons in 1980s to 90 million tons in 1987. By the late 1990s, integrated steelmakers' capacity is likely to decline another 25-30 million tons. With only a few exceptions, high construction costs, higher costs, and higher steel worker wages, high wages, have made investment in large-scale integrated capacity an uneconomic proposition since 1970s. So that didn't create a good investment environment. Please take a look in this short video clip about how the tariffs are already impacting United States businesses and how it can impact the future of their stock prices.
We want, buy American. Our industries have been targeted for years and years, decades in fact, by unfair foreign trade practices leading to the shuttered plants and mills.
Originally, Trump's tariffs were meant to save U.S. steel jobs, but in practice, the tariffs are actually hurting U.S. businesses that rely on steel and aluminum. Companies like Look Trailers in Indiana are feeling the heat from Trump's trade move.
So we've seen steel prices go up 25%, aluminum as high as 35%. So that was the first hit, and that's already taken place. The suppliers that we have, tube mills, et cetera, have been passing on increases. So what we're trying to determine is what the second phase in is. Is it going to be 0%, 10%, 20% more on top of what we've already weathered in the last 6 months?
Though the company already uses 75% U.S. steel and aluminum, now its competitors are also moving from foreign to domestic steel. That's driving up demand for steel producers domestically and adding costs to businesses' bottom lines.
The biggest impact is immediate because the economy's been strong. We've had our deepest backlogs in history. And so we've had committed orders, committed prices to our customers, and we've been getting hit and absorbing price increases and then pricing out 3 months. So the net effect has been the same on the whole industry in this area, whether you're public or private. The hit has been to your bottom line.
Trump's plan is to reopen the shuttered steel mills to add new life into American steel. But that process could take up to 18 months, leaving some businesses without enough U.S.-made steel and aluminum.
We've tried to be more productive. We've tried to be leaner. We've tried to bring in less material at a time. Although with rising prices, you try and take advantage of cash and buy material up front. But it's a two-pronged problem because the labor market's tight. So we've had rising wages. So really, it's just a battle every day. It's how to get more out per man hour while you're battling rising wages, competitive workforce, and now you add the third one, which is rising raw materials. You have to be right today. There's no margin for error.
The average cost of a trailer from Look is already about $3,500, a 9% jump from 2017. During the last big steel tariffs back in 2002, companies like Look Trailers had a 10 to 15% hike in prices, followed by a drop in sales. Businesses are hoping this time will be different.
Now, here's the good news. You cannot control the tariffs. You cannot simply control certain situations in your life. You cannot control what he did. You cannot control the upcoming recession. But what you can control is this. You can control what you do about it today. You can take action now and not end up like certain people in the crash of 1987, like certain people ended up in the dot-com crash, like certain people just not so long ago, literally 10 years ago, ended up losing fortunes in the crash of 2007 and 8. Take action now. Do not let the upcoming market crash in the recession take advantage of you. If you're a brand new trader looking to find out how you can profit with this new market environment, whether you're an experienced trader looking for brand new strategies to take advantage of the upcoming market environment, visit marketcrash.money. Simply hit right here, how to profit. Schedule a one-on-one consultation. Learn more about what the power of options can do for you and your financial future. Thanks for listening. I'll catch you on the next video.